Good afternoon, everyone, and welcome. My name is Derek Job, and I am a team lead and financial advisor here with the Apella Wealth team. We're glad you could join us today for our August edition of Apella Academy, From Curveballs to Catastrophes, How Smart Risk Management and Insurance Can Be Your Financial Safety Net. This is an important subject and one that aims to focus on the role of insurance and risk management in your financial plan. So a couple of quick housekeeping topics. We are recording this webinar, and we will provide a copy of it within the next few weeks. Additionally, all of the previous Apella Academy webinars are available on our website at apellawealth.com under the events page. And if you have any friends, family, or colleagues that you think would benefit from any of this information or from previous sessions, please do not hesitate to send the recording their way. Our next Apella Academy will be focused on next generation and college planning on September 10th. So please make sure to sign up. And throughout this presentation, if you have any questions, please submit them in the Q&A box below, and we will be sure to address them at the end of the presentation. And any that we're not able to get to due to time constraints, we will be sure to follow up and answer. Risk management is an extremely broad topic, and it's one of the only things that truly impacts every single person during every unique phase of their life. However, since we only have an hour, we will be focusing on a couple of more specific topics. And during this, I will be joined by two other speakers who are experts on the subject matter. So our first speaker is my incredible peer, Bill Suppley. Bill is a certified financial planner, certified financial analyst, and senior financial advisor out of our Berwyn, Pennsylvania office. Bill will be discussing a really important subject that is becoming more and more prevalent as humans' life expectancy continues to climb, and that is long-term care. And more specifically, Bill will be discussing the rising cost of long-term care and how long-term care insurance might or might not make sense for you. And after Bill, we will be hearing from Peter Laponis. Peter is also a certified financial planner and senior financial advisor, and he works out of our West Hartford office. Peter spent many years working in the insurance industry, so there truly is no better person to discuss the crossover between insurance and financial planning. Peter will be discussing an often taboo topic that is commonly misunderstood, and that is the dreaded annuity. So Peter will touch on the different types of annuities, how they are taxed, and the pros and cons of each. Our goal during this webinar is to simplify complex topics, address common misconceptions, and help you walk away with a clear understanding. So again, a quick reminder, if you have any questions, please submit them in the Q&A box at the bottom of the screen. And with that being said, Bill, I will turn it over to you.
Well, thank you, Derek. As Derek mentioned, I'm Bill Suppley. I'm a senior financial advisor in the Apella Wealth office in Berwyn, Pennsylvania. I'm going to discuss with you long-term care planning, why it's important, what are some of your options around long-term care planning, and we're going to take a little bit deeper dive into some of the ins and outs of long-term care insurance. Long-term care discussions are ones that we have with most clients, either for themselves or for one of their loved ones. It's a very common topic in our office. Planning for long-term care has become increasingly important over the last several decades due to several factors. The number one is our aging population here in the United States. The U.S. Census Bureau in 2020 recorded 58 million people over the age of 65. But then they go on to project that there'll be, in 2050, there will be over 82 million people over 65. This is an increase of the older population of 60% over the next 24 years. Over the past several decades, many decades, life expectancy has also dramatically increased. In 1935, when Social Security first started, life expectancy was 61.1 years. In 1965, Medicare started and life expectancy was 70 years. Today, it's 77.5 years. You can go back one, Derek. Memory care is currently one of the biggest drivers of long-term care, healthcare costs and cost escalation. Um, 3 out of 5 patients who need care 100 days or longer have some instance of memory care problems. This could be in association with other health problems, but 3 out of 5 who require care have some memory issues. Memory care also, which is interesting, is uh, sex specific. The Alzheimer's Association estimates that 1 in 5 women today who have reached the age of 45 years old will have cognitive issues at some point over the remaining lifetime. And for men who have reached 45 today, it's going to be 1 in 10. So women have a 2 times more risk of having some sort of memory care or cognitive issues. Women are also 2/3 of all the insurance claims. So this is due to longer lifespans, different mortality patterns, and these cognitive issues we just covered. Now, let's discuss some of the costs of care. If you need long-term care or somebody you're taking care of or you're responsible for needs long-term care, it can be very expensive. A lot of this depends on where you're going to get care, the type of care, and the quality of care. The median cost, the middle cost for care in the United States in 2024 was $8,600 for a semi-private room. But this is projected to increase by 60% over the next 16 years. There's a tremendous amount. This growth rate is a little less than it has been over the previous 10 and 20 years because Genworth is projecting that it's only going to increase at 3% a year. I personally think this might be a little late, but just based on what we've seen around here. The Forbes Long-Term Care Survey says the average costs have tremendous variance by state. Alaska being the highest cost state, this is for the average care of $7,246, where Missouri is the lowest cost state, $3,183 per month. So when you consider long-term care costs, there's large variations between states, between counties, and between localities. So I'm in southeastern Pennsylvania near mainline suburban Philadelphia. For the whole state, the average is $426 per day. But very local to where we're sitting right here in Bryn Mawr, the average cost is more like $700 a day. So where you get care has a tremendous impact of how much it's going to cost. How long are you going to need care? All right, this is a difficult question. How do you know? 36% of men and 41% of women need paid care for 5 or more years. And long-term care, as we see it, it's usually a progression. It goes from unpaid care by your family or your friends. Sometimes it's part-time nursing care. You hire someone to come in for a few hours a day, or you're using for cognitive issues, maybe adult daycare or something like that. And then it progresses on to full-time care. Average lifetime cost, if paid care is used, according to this chart, is $332,000 for women and $240,000 for men. Remember, about half of all people are going to need care, and they're the average of costs. Reasons for some of this disparity between men and women include the women's longer life expectancy. And of course, men have historically died more suddenly, some say more stupidly than women, but you can see that reflected in the lifetime costs and durations. There's lots of options for paying for long-term care, but don't think that you can rely on Medicare for coverage. People who use Medicare, it's very limited and there's very specific rules to follow. You get 20 days of coverage after a hospital stay, and then you can get up to 100 days of coverage for copay. But that's not a good plan for long-term care. Let's look at some of the most common ways to pay. As we mentioned, family and friends is the first thing that most people rely on when they're in that position. Taking money from your savings, reducing expenses. you're probably not going to take that trip if something's happened. And if you're married, your spouse probably isn't going to take a trip. The big savings there. Insurance, which we'll cover in greater detail, is another method to cover these expected costs. Continuing care retirement communities, some people call them life plan communities. They're very popular where we are. That's where you pay an entrance fee, and they in turn, and a monthly payment, and they in turn will take care of you for the rest of your life as you progress from independent living to maybe some nursing care to maybe skilled nursing care, whatever it may be. So it's been a big consideration for a lot of people recently, and it's a very interesting topic. Home equity is, for many people, the source of a lot of assets to pay for care. So that can be in the form of reverse mortgage. It could be in the form of selling your house if need be. Certain people are more likely to use their home equity. For example, if you're single, you have no heirs, it's a perfect solution for you. Medicaid, however, Medicaid is a last resort. If you have specific questions about Medicaid, you should consult an elder care attorney. If you think you're going to use, or somebody you care for is going to use Medicare, make an appointment early, because there's fairly long periods of look back for assets, and with proper planning, they can help you save a tremendous amount of money. Long-term care insurance. So long-term care insurance covers chronic conditions, which are usually defined as permanent conditions affecting people who have lost the ability to care for themselves. It's not covered by regular health insurance. Very common long-term care conditions that trigger insurance are respiratory disease, Alzheimer's, dementia where supervision is needed for your safety, heart failure, musculoskeletal diseases, rheumatoid arthritis, all sorts of these. These are the types of things that long-term care insurance is designed to cover. Interesting about this is many insurers over the last several decades have increased the age for when they want to cover people for long-term care coverage. They used to insure relatively young people. They don't like to do that anymore. They had bad experiences with diseases such as MS and lupus. So it's moving towards older people for insurance. Let's look at when long-term care coverage would pay for your care. All right. When you can't perform two activities of daily living, any of the two, if you can't get out of bed, you can't get dressed, you can't eat, you can't brush your hair, any two in combination is pretty straightforward. Then the insurance, you can file your claim and the insurance will kick in. They'll pay for assistance in many different ways and different locations. They can pay for care coming in your home. That's somebody coming in from anywhere from 2 hours to 4 hours to more per day, in an assisted living facility, in adult daycare. Once again, more common with memory care, or in a nursing or skilled nursing facility. In Philadelphia, we have specific policies that only pay for care in your home. They're also available in several other states. So that's another option rather than long-term care. Let's look at the type, why we should insure ourselves. Mostly so you don't be a burden on others. That's one of the reasons that a lot of people that we've discussed want to have insurance. The second really big one is asset protection for heirs. So they want to protect the money they have to pass on to children or grandchildren or whoever. It also gives, having insurance and having resources, if you don't have other resources, gives you flexibility in choosing who will provide care for you and gives you a sense of control. But that being said, there's lots of reasons that people don't insure. Insurance is not always the best option for everyone. Everybody's circumstances are slightly different. They need to be discussed fully. For some people, long-term care insurance is simply not affordable. So if that's the case, you just can't, that doesn't fit your budget. Do you want to partially insure at that time? That's a consideration. Some people on the other end of the spectrum have abundant resources and feel that they don't need or either don't want to insure because they have such net worth and resources that it won't make any difference to them, won't make a difference to them or their heirs. Other people are phased out of insurance because of age. If you're too young or you're too old, the AARP, they suggest that the sweet spot for long-term care insurance is the 60 to 65-year-old. That's the point where it's more affordable, but you can still get the coverage. If you wait till you're 70, of course, your rates are going to go up higher. If you start at 55, you're going to get a better rate, but you're going to be paying it for another 5 or 10 years. And a really big one is health. You have to be in good health. So if you think, I'm not going to buy long-term care insurance, I'm going to wait a while, and then if something happens, that won't work, because if you don't pass the health screening, they're not going to insure you. If you do want to insure, there's many different types of policies to consider. The two basic types of policies we see, and each one of these has many variations, is traditional long-term care. This is a policy where you pay in yearly, right, forever, and to get a benefit, right? Traditional comes in both individual and joint lives. If you get a joint life policy, like me and my wife have, you get a discount because insurance companies' experience is that spouses will tend to take care of each other much longer than an individual before using other long-term care facilities. So you get a discount generally with a joint life policy. Hybrid policies are a relatively new development, but they're policies that combine some type of insurance product with a long-term care benefit or a rider, right? It can be a life insurance policy with a rider that kicks in if you do need money for long-term care. That life insurance policy can accumulate cash value. It can be used for legacy planning for your children. It can grow over time. These type of things we've seen are more often used by higher net worth people. You can also combine long-term care riders with an annuity. If you can have an annuity where, let's say you're getting $50,000 a year annuity. And if you do need long-term care, the rider would allow you to take up to 50% more, or $75,000 a year for 3 years or 5 years to pay for long-term care. Right? Pricing of policies, these are all very complex, just so you know. Pricings of policies are based on your age, either your single age or your joint age. And certainly a difference in pricing if there's a big disparity between spouses. How long of a period do you want to be covered for? Do you want to be covered for 2 years, 3 years, 5 years? How long? How much is the daily benefit? Are we looking at $300 a day benefit, $500 a day, $200 a day? Each one of these goes into the calculation. How much inflation protected? Inflation protection is required. As we saw in the earlier example, Genworth projects that costs will increase by 3% a year for the next 14 years, but we don't know. It's been higher than that historically. Do you need 2% inflation adjustment? Would you like 3%? And then the last is, how much of an elimination period would you want? And the elimination period is how long before you have an event do you have to pay for it yourself before the insurance kicks in. So these common periods for this are 60 days, 90 days, 180 days, something like that. We've seen 90 days most often because that tends to integrate more with Medicare coverage. So Medicare picks up the first 20 days and there's a copay up to the next 100. So that seems the most often thing we've seen. Planning for the correct amount of long-term care coverage is complex. Estimating your future costs is very difficult. Some of the factors you have to consider is, where do you want to be taken care of? Do you want to be downtown New York City, or do you want to be in Albany or a more rural place? Where are you going to be? Where do you envision care? What is your strategy? Are you going to be taken care of at home for the rest of your life? Do you want to be in some sort of nursing facility? Are you going to enter a continuing care retirement community, each and every one of these impacts how you evaluate the insurance and what's the correct amount. Another thing is how much are you willing to self-insure? If you think you're going to need $400 a day benefit, do you buy an insurance that covers $200 a day? Do you buy insurance that covers $100 a day? This decision is generally different for most people depending on circumstances. Remember, if you overinsure insurance, my view is you don't want to overinsure too much because only 50% of people are ever going to need this coverage to begin with. And the big one is how much spending can you take from other sources, right? If you're going to have $8,000 a month bill for long-term care, the $3,000 or $3,500 you're getting from Social Security is probably not going to be spent on anything else. So you might only need $5,000 worth of insurance company coverage. Sorry. Well, I know this is a big topic. There's lots of moving parts, but feel free to ask questions. You can ask them in the chat or reach out to your financial advisor to help you understand the long-term care planning process and to find a solution that best meets your needs or the needs that you care about. And if you have any questions on the top of mind, particularly about somebody who needs to discuss how to take care of a parent, a sibling, something like that, just reach out to us. Thanks. And
thank you, Bill. Good afternoon, everyone. Peter Laponis, and I will be taking over for the second half of the presentation. As Derek had said, I spent a significant portion of my career working in the insurance industry, so I have a very good working knowledge of all types of insurance, especially annuities. And so one of the questions that I get when speaking with a client or prospective client, they'll ask about annuities and say, you know, I have an annuity and I read that it's bad. Is my annuity bad? And my response is always to answer their question with a question saying, well, it depends. What type of annuity do you have? Because an annuity to me can mean several different things. So on the next slide, what I want to do here today is to look at the 4 types of annuities, talk about them briefly at a very high level, and then give you some real life examples, some of the inner workings of them with real statements to hopefully further educate you on what some of those benefits are. So the first slide we'll get into is fixed annuities. So the key features, they're going to provide a guaranteed interest rate for a specific period of time. The principal is protected and guaranteed regardless of market conditions. So if the market is going through a period of great volatility, lots of ups and downs, your fixed annuity, it's very predictable. It's going to continue to chug along. You won't see it dropping in value. And the growth is tax deferred. A couple of themes that are going to continue to come up throughout this part of the presentation is the tax deferral on annuities. If we take after-tax money and put it into an annuity, one of the benefits is tax deferral. We can also use annuities with IRA money. However, we already have, because it's an IRA, we already have that protection or that tax deferral built into the IRA. But we'll get into that more throughout the presentation. So the pros, fixed annuities, no market risk. The fixed returns, they simplify planning. There's not a whole lot of maintenance required with a fixed annuity. The cons, lower potential returns. Again, we're getting guarantees. The insurance company, the financial backing of the insurance company is giving us guarantees on our money. And so because we're removing guarantees, we're missing out on the potential returns of the equity markets by taking more risk. Limited flexibility, and penalties may apply for early withdrawal. So most annuities out there go anywhere from 3 to 10 years. Some could be more, some could be less. And if you were to take your closure contract out before its maturity was up, there'd be a significant penalty from the annuity company in doing so. You are allowed to get out a small portion of your account. It could be a percentage, say 5 or 10% on an annual basis, or the interest that you've earned over a particular year of the contract. But just understand, by putting money into an annuity, it is locked up for a significant portion of time. So on the next slide, I have an actual proposal here that I want to show you. We have a female here, age 65, non-qualified. This is after-tax money, $250,000. It's a 5-year annuity contract. She puts the money in today, and every year for the next 5 years, she will be guaranteed 5.45% on her money. And the columns continue to show the interest credited every year, how the account value grows every year. Again, this is all predictable, all guaranteed, pretty simple and straightforward. Note the surrender value, the difference between the account value and the surrender value. That gives you an idea of what the back end or the deferred sales charges if they were to close the contract out early. So if she did need money, let's say hypothetically, this contract allowed her to get her interest out. So at the end of the first contract year, she calls the insurance company and says, well, I would like to have my $13,625, my first year interest, please send that to me. So they would send that to her this year. And then what would happen is she'd get taxed on that, taxed at ordinary income rates. That's another important distinction with annuities. It's going to be taxed at ordinary income when you take out the earnings. All right, the next slide, please. Next, we get into indexed annuities. So an indexed annuity, what this is doing here, we are tracking an index. For this example, we're going to use the S&P 500. It's very popular, very widely known. And the indexed annuity allows you to participate in the upside of the markets. So you get potential for earning more than a fixed annuity, but on the downside, your principal is protected. It's guaranteed. So you're tracking the index. If it does well, you participate in a piece of that upside. But if it doesn't do well, you're not going to have a loss to your principal. And again, with non-qualified or after-tax money, we're getting tax deferred on our growth. You will not be taxed until you actually take money from the contract. So the pros: upside potential with no downside risk, and not a direct investment in the market. We're tracking an index from point A to point B. We're not going to be investing in the market. The cons: the gains are limited by the caps or the spreads, the participation rates. So we're not getting the full upside of the market. That's one of the cons. And while this particular example we'll show you on the next slide is somewhat straightforward, these caps and participation rates, they can be difficult to understand. There's some complexities to them. So this is an actual client statement from Jackson National Life. This is a low-cost indexed annuity that a client recently opened with me. She had an old variable annuity contract. She didn't need it for her planning. It's passing to the next generation. She wanted some guarantees built into it. And so how does this work? If we look at the top left, annual reset point-to-point cap. This contract was opened in June of last year. Or I should say, yeah, June of last year, the contract was opened. And what happens is with the index, it started out at 5460. That's what the S&P 500 started at. That is point A. Point B was July of this year. 12 months later, the market was up. And so we're tracking point A to point B. So if we look to the right, we started at 5460, we end at 6229. That represents an increase of 14.09%. When the contract was open back in June of 2024, there was a cap, a declaration rate of 9.25%. The index did 14 over 12-month period. She will get 9%, the cap. She maxed out the cap and has that interest credited to her account at the end of the 12th month. So it's important to note here, not participating in the index, her balance in the account did not change for a full 12 months. She had the 9.25% credited at the end of the 12th month. So let's take a couple of hypothetical scenarios. What would happen sorry, Derek, if you could go back to that other slide. Thank you. What would have happened if the market started out at 5460, the S&P 500, and it was up only 5%? Well, her cap would still be at 9.25. She would have gotten 5% interest credited to the account at the end of the 12th month. Another scenario, if the market was down, if it was down 10%, she would not have gotten any interest credited because there was no market upside. However, the cash value, the balance in the account would not have been reduced. So her balance would have stayed flat over the course of the year. And now in June of 2025, July of 2025, the second contract anniversary begins and a new cap gets declared. And then 12 months later, we'll see what happens to the market or to the index at that point to see how much interest would be credited in year 2 of the contract. So the next slide, we're going to get into variable annuities. And if annuities have a sort of a bad name, this is probably the culprit. So variable annuity, the returns of the contract are based upon the performance of investment subaccounts. That's basically insurance speak for mutual funds. So inside of a variable annuity, you have different subaccounts, growth, international, small cap, all different types of investments. And you're going to have the potential for market upside, longer term growth. In addition to these investments, there's also guaranteed riders that you can choose for a fee. There's death benefit guarantees and income benefit guarantees. So there is a broad investment choices. Typically, you're looking at, say, 20 to 50 different choices inside of a typical variable annuity contract. And again, with non-qualified after-tax monies that are invested, tax-deferred growth. On taxation, variable annuities, even though we're investing in the market, you take the earnings out, your taxation, again, ordinary income, not capital gains treatment. So the pros, greater growth potential because we're investing in the market. We're taking more risk than with a fixed annuity or an indexed annuity. We have customizable features that are a part of a diversified retirement strategy. So whether it be the diversification you get because of the portfolio that we can create, customized to your risk tolerance, or choosing a menu of different guarantees and different riders, we've got a lot of flexibility with these products. So the cons, subject to market risk, no principal guarantee on your cash value. The fees and expenses can be high, as well as extended surrender periods, long holding periods, 5, 7, 10 years. And some of the riders can be very complex in nature. And so on the next, and may not be suitable for all investors. So what we'll do on the next slide is, this is another client's variable annuity with Lincoln. This is a product they've had for over 10 years. It was purchased through another advisor. And there's two components of this that I want you to pay attention to. On the left-hand side, we have the account value. As of 6/30 of this year, it was worth $1.037 million. And that is going to fluctuate based upon the underlying performance of the subaccounts or the funds. On the right-hand side, there is a guaranteed income rider built into this contract that they chose when they opened it for a fee. There is an income base of $1.2 million. So that base has been accruing at a guaranteed 7% year after year since they opened the contract over 10 years ago. This contract is currently out of surrender. So if the client called in to Lincoln and said, send me my money, where people can get confused is they may see, oh, send me my 1.2 million. Well, no, that is used to calculate a guaranteed income. If you wanted to close the contract, they'd be sending you the 1.037 million. So on the next slide, let's talk a little bit more about this guaranteed income. So we have a income base guaranteed of 1.2 million. It was been growing for 7%, guaranteed over the last 10 years. That 7% growth stopped after the 10-year period. So this is a husband and wife. This is actually the wife's contract. When the wife turns 62, she can turn on a guaranteed stream of income of $42,772 that is going to go for the rest of her life as well as her husband's life, joint life expectancy. So regardless of how long they live, regardless of what the markets do, it is going to pay the $42,000 plus per year. They waited a few more years to age 67. That amount goes up to $48,000. Again, this is guaranteed income that they as a couple cannot outlive. On the next slide, we're going to talk about the expenses. So, and not all, there are low-cost solutions out there for all types of annuities. As you can see, the expenses here are very high. M&E, mortality and expense risk, this is what the insurance company uses to compensate them for their customer service team, sending out statements, tax reporting, but also the commission. These expensive products have to do with the fact that a commission is paid. Being fiduciaries here at Apella, we do not deal with commission-based products, but the commission is recouped by the insurance company through the M&E. The income rider that they were with that guaranteed income base, that 1.2 million we were looking at, they are paying 1.25%, will continue to pay 1.25% for the life of the contract, whether they use that income rider or not. The sub-accounts and the funds, the expense ratios are high inside of many variable annuity contracts. The portfolio they have, the average expense ratio is 1%. All in, total expenses on this contract are 3.6 million. So what we're doing now with this client is we're taking a look. We're ascertaining, hey, they don't like the expenses. We've gone through them. They don't like paying these high fees. However, there is a benefit, a guarantee of income in this contract that might be appealing to them. So we're in the process of figuring out, do we stay and turn that income on at some point, understanding that we are going to be paying high fees, or is there a lower cost solution for them? But if they take that lower cost solution, they lose that guaranteed benefit. So the last piece, immediate annuities. The first three annuities that we looked at were accumulation products. This is a decumulation product, meaning it's paying an income. And so I liken this to a pension that a school teacher or a police officer may have. Your income will begin immediately, typically within 12 months, funded with a lump sum. You're writing a large check to an insurance company. They in turn are promising you income over a specific period of time. Those payments can be fixed or variable, depending upon the contract, and typically can start quickly within 30 days, but at the long end, it would be 12 months. They offer a guaranteed lifetime option. They will continue to pay as long as you are alive, regardless of how long you are alive. This reduces longevity risk. People, if they are healthy, have a good family tree with longevity in the family, they could be concerned about outliving their money. This helps to reduce or alleviate that fear. So the pros are ideal for retirees needing immediate cash flow in retirement. You retire August 1st, September 1st, you can, in theory, have your first check to you or your first deposit. Simplified structure with predictable payouts. We're going to get $1,000 a month on the first of every month for the rest of our lives. Pretty simple and straightforward. This can be tailored for a lifetime or lifetimes. So could be a single person, could be for spouses. Over their lifetimes, a set period of time, say we want it for just 10 years, or a combination of both. The cons, once the payouts begin, the payments begin, it's irrevocable. We can't go making changes. There's not a whole lot we can do. No access to principal after annuitization. So once the payouts have begun, we can't go back asking for monies. There are some products that allow that, that are newer in the marketplace. However, if you did do that, it would impact future monthly payments. And then inflation may erode purchasing power. Back to that example, $1,000 a month for the rest of your life will, because of inflation, that will purchase less over time. And so I've got a couple of proposals here on the next couple of slides. The first one here. So we have a 65-year-old female. She is taking $250,000 after tax money, non-qualified. This is going to pay her $1,565 a month for the rest of her life. So with this, because it was after-tax money, you could use IRA money, but after-tax money, there's an exclusion ratio. And what does that mean? She's writing this large check to the insurance company. Every payment is part of return of principal, and she's also getting credited interest because she's given so much money to the insurance company. So $1,565 per month, 1,041 of that is a return of principal, 524 of that is interest. She will get a 1099 at the end of the year for the 12 months worth of interest. Ordinary income is what the tax rates would be on those. So with this is single life annuity. This woman is age 65. The life expectancy is roughly 13 years. If she were to die at age 67, the payments stop, the insurance company keeps the money. So on the next slide, we're going to build in some protection for her. So this looks pretty similar, this proposal, but at the top left, single life annuity with installment refund. So initially, the monthly income on the last slide was $1,565. It's now $1,525. So for $40 a month, we've built protection in for her spouse. We've built protection in for whoever her beneficiary is. It could be a family member. So we have a 13-year life expectancy. If, again, dying at 67, 2 years into the contract, the payments will continue to the named beneficiary for the remaining 11 years until that $250,000 has been recouped. And so there's all sorts of ways to help to protect your loved ones when doing an immediate annuity. So the final slide here, can I benefit from the annuities that we discussed, some of the features? And I think when we start talking about guarantees and tax deferral, those are powerful messages that can appeal to some people. Why do annuities get bad press? Well, high fees, they're commissionable products, could be sold inappropriately at times, and also some of the long holding periods, the long surrender charge periods. How do I know if my annuity is right for me or if I have one of those bad annuities? Well, ask your advisor. Do a review of the annuity. Understand what you have. It may not be the best annuity, but it may have a feature or benefit that really could make sense to keep. Or there could be a low-cost solution out there that could give you some better benefits. But ask your advisor. And as we collaborate here at Apella, I'm always a resource for any of the advisors here at the firm if they did have further questions.
Awesome. Peter, Bill, that was fantastic. That was a lot of great information on a couple of really important topics. So thankfully, we still have 15 minutes here, and it looks like quite a few questions have come through. So like I said at the start, we will do our best to get through as many questions as possible. And any that we aren't able to cover, we will follow up and make sure we get those questions answered. So let's see here. Let's start filtering through some of these. First off, for Bill, is there any tax advantage to long-term care insurance?
Thanks, Derek. Yeah, there are some advantages. There is a deduction for it depending upon your age. So this year, depending on how old you are, you get a bigger deduction. If you're 50 to 60, I'm looking at it, it's $1,800. If you're over 70, you can get a $7,000 deduction on your income taxes. But this only applies to people who itemize. For people using the standard deduction, there's not a lot of tax advantage to it. But if you're in the position to be able to deduct it, it's subject to the rules.
Great. Well said, Bill. So for Peter, with the 1035 exchange, can you go from one annuity type to another, or do you have to stay in the same type of annuity? So I think, in other words, can you go from fixed to variable, or do you have to go from fixed to fixed?
Yeah, so when we replace annuities, there's a term of 1035 exchange. You're not going to pay tax on it. And yes, so you can go from variable to fixed, or fixed to variable, or variable to immediate. So yes, you can do that, and it is a tax-free exchange.
Let's see here. The money in the bank has protection, FDIC insurance. Is there something similar that protects annuity owners?
Yes, so annuities are really regulated at the state level. We talk about FDIC, that is through the federal government. There is something every state has called a state guarantee association, and it will provide a specific level of protection for certain annuity contracts, and that's guarantee ending with a TY, not EE. And so every state is a little bit different, but there are some protections in there for certain types of annuities through the State Guarantee Association.
Well said. Let's see here. Bill, do you feel like you need to have insurance for long-term care insurance for the whole amount of the expected costs? And what about accounting for inflation, as costs, like you mentioned, tend to increase over time?
Accounting for inflation is always a big unknown. we uh we we recommend that you at least take it into consideration with your plan. And so we model a little higher than 3% just to be on the safe side to see where we stand. Um, you don't have to be insured for the whole amount. This is recent experience. We had client, their costs were around $13,500 per month, and part of that came out of the Social Security payment, which they weren't using for anything else. And then they had partial long-term care insurance. So they were out of pocket about they weren't insured fully, but they were out of pocket about $4,000. You can look at this as, I want to be fully insured, because that's what it's not like buying house insurance or car insurance. You're sort of making a bet that you're going to need it. So do you think you're going to need $8,000 a month, $10,000 a month, or more? Or I mean, I know it's sort of silly, but there is a probability that you just drop dead, and you never need 1 day of care. That happens. It's a coin toss, 50-50 if you get insurance, whether or not you need it. So generally, you can insure for a lesser amount, but that's a personal consideration. Depends on your other circumstances. If you have other monies in the banks, if you have equity in your house, if you have investment accounts, things like that.
This is a great question from Jeffrey. With annuities, do you ever mention the net return after fees, or are they mentioned in any of the policies and statements that we see? Because we more often see, statements and policies that we get from clients who already had them prior to joining Apella.
Yeah, so for the specific annuity, if your statement has performance information on the statement, that should be net of the fees. Those high fees should have been netted out already. So if your annuity has a 3% fee, like my client's Lincoln annuity did, and it said the performance for the quarter was 10%, in reality, without the fee, it would have been 13%. But yeah, that should all be netted out in performance data on the statement.
And do RMDs apply to annuities and qualified accounts?
They do. Again, for IRA annuities, and you would have to pay attention to what the RMDs, and again, the insurance companies are pretty good about calculating that for you, making sure it's processed.
This is a great question here. A little bit of a backstory. So 2 of my aunts had long-term care insurance, and both of the companies became insolvent. It's tough luck. For one of them, the rehabilitation plan resulted in a large increase in premiums and a large decrease in benefits. If I get a long-term care plan, how do I protect myself against this, or is there a way to protect myself against this?
Yeah, let's going back to what Peter says. So these insurance products are regulated at a state level. The state insurance commissioner in most states, there's a pool to fund this if they do go defunct. But how long-term care works is everybody who's in the plan is subject to, the entire class is subject to a price increase. They can't just pick a Derek out and say your rate goes up, but they can put everybody in the plan can get an increase. And this is if they're having higher expected losses, lower expected returns on their portfolios or something like that, they can apply and they can have an across the board rate increase. The rate increase would apply to everybody. You don't have to agree to the rate increase. Your option in that case is to have a reduced benefit. So that's what we see on some of them. There was tremendous amount of them about 10 years ago. I haven't seen quite as many recently, but that's how they keep the thing solvent for all the other members in the plan. And the insurance companies, it has very little to say. They have a little bit, but they have very little to say about how you can contain the increasing costs of providing care to people. So when the costs go up dramatically, they have to pay out more. And if they would just pay them all out, eventually the pool would deplete itself and nobody would have any coverage.
And to sort of piggyback on what Bill said, my assumption here is that these are policies that were taken out a long time ago. And when long-term care policies first started, the insurance companies didn't have a whole lot of data. They had data on people dying, a few hundred years worth of statistical data on people dying. This was a relatively new phenomenon as far as us living longer and the things that were killing us, say 10, 15, 20 years ago, because of medical technology and advances. It's now we're coming out of a severe disease and living, but we just need we need the care. Whereas 15 years ago, it was killing us. So that they did not have these statistics, and that ultimately led to a lot of issues with increases in prices, companies going defunct. I'm not going to say you're immune from it today, but I think the likelihood would be less today than it was, say, when your aunts purchased this care.
I agree, 100%.
Let's see here. Peter, can you build in a feature to protect your spouse in an indexed annuity?
Well, yes, because you would make your spouse the beneficiary. And so if something were to happen to you, your spouse would then take over. Very similar to an IRA. You pass away, your spouse becomes through spousal continuation. So that would be for the cash value. But if you wanted some type of income feature off of the annuity, yes, to have it based upon your life as well as your spouse's life, you can build that in as well.
Follow up from a previous question. So what should a client do if the insurance company does become insolvent, or is there anything that they can do? Or are they basically just, I think they're kind of just stuck with whatever the resolution was presented by the insurance company?
Yeah, and I haven't had any insurance companies go bankrupt on any of my clients, but I believe they just become a member of the settlement in the class, and it can unfortunately, they'll try to unfreeze, but it can if you're receiving payments from them, that could be an issue. But I haven't heard of any of those or read about any of those happening in a long time.
Yeah, great follow-up question from Sean here. Should people, which I think you kind of just answered, should people consider the financial health and claims reputation of the insurance company when choosing a long-term care insurance policy?
I think every time you buy insurance, you should consider the financial health of the client. We like to use one of the more top-rated clients. You can go down on any of the insurance rating scales. You can go down, if you go down to a lower-rated insurance company for an annuity product, they'll probably offer to pay you a higher rate of return. I'd much rather see a highly rated insurer, A+ or something, rather. It's similar to putting money in the bank and getting 1% or 2% and then loaning to somebody you barely know or something, your brother-in-law or something.
Mm-hmm. We'll get to one more final question because we're running up against time here. What money would you use to pay for long-term care, whether it's savings, IRAs, Roth retirement accounts, things of that nature?
So I'll try to cover this quickly. This is a really important topic. If you need, we've done this for several clients, we calculate out if you need to pay for care, what happens is you're paying large medical expenses. Let's say they're $10,000 a month, $12,000 a month, whatever. You're probably in a position where that's going to be a deductible medical expense. When you get to that position, you want to, instead of paying for money out of your savings or out of your bank account, then you're in a position to be able to take that out of an IRA or a qualified account and get that money out of that IRA at a very low or no tax cost, because you're going to have an offsetting deduction. So that money in your IRA is taxable, but if you need to spend it for healthcare, long-term care, you can get it out at a very low tax cost. And it's much better to spend that money down and let your children inherit your other money tax-free, because they get a step up in basis in that, then spend your money out of your bank accounts down and leave them the IRA, which they have to pay regular taxes on.
So in other words, always talk to your advisor before deciding how you're gonna, spend this type of money. And if anybody you know is trying to make this decision, I would definitely recommend they speak with an advisor as well. Again, fantastic job, Peter, Bill. It was a lot of great information. So like I mentioned earlier, this was recorded and it will be available on the Apella Wealth website under the events page within the next couple of weeks. And also our next webinar is on September 10th, and that will be focused on next generation college planning. So please make sure to sign up. Thank you again to everyone for attending, and we look forward to seeing you during the next presentation. Have a great day.
Thanks, Derek. Thanks, Peter.
Thank you.